Hello, welcome listeners and market participants, and welcome to KBRA's European Credit Podcast, Conversations in European Credit. I am Gordon Kerr, Head of European Research at KBRA, and today I am joined by Ken Egan from our Sovereign Ratings team.
Hello, everybody.
And Kareem Nassif from our Corporate Ratings team.
Hello, everyone.
Today we will be covering the topic of geopolitics and their impact on energy markets. A report on the topic titled European Corporates, Muted Impact of Geopolitical Tensions on Energy So Far can be found on kbra.com, along with a number of related publications, such as our report about the slowing of production and margin compression in Europe, and a number of reports on the private credit world. Jump on the website and have a read. They are good. Rising geopolitical tensions pose indirect risks for corporate profitability and inflation in Europe via their potential impact on energy prices, transportation costs, and a feed-through into broader macroeconomic conditions. To date, the impact of the events in Ukraine and the Middle East and the ongoing risk of escalation have had a relatively mild influence on commodity prices. In contrast, shipping costs have experienced more volatility, and their impact on corporate profitability will largely depend on the current tensions being sustained. Despite a deterioration in terms of geopolitics, global economic forecasts and sentiment have improved, and energy prices have broadly remained range-bound. However, the risk of an increased impact remains high, and so with that, let's get the conversation going. Ken, geopolitics are fast-moving at the moment, and our comments may be quickly out of date, but can you give us a bit of a picture about just how elevated they have become?
Yeah, they certainly are fast-moving at the moment. As we highlighted in the report, global geopolitical risks remain elevated and are likely to remain elevated through the remainder of the year. To give you an idea of how much so, we have identified a geopolitical risk index developed by two researchers, Caldera and Iacoviello, which monitors news mentions of geopolitical incidents such as war, conflict, and other key metrics via automated text search results from electronic archives of 10 newspapers. This measure remains elevated in comparison to the period prior to 2022. However, it does remain below the onset of the Russia-Ukraine conflict. That said, a sub-index, which reflects the volume of actual acts of violence mentioned in the press, currently remains elevated at a close to that of the onset of the Israel-Hamas conflict. This highlights what we're all feeling as we see tensions experienced across the globe. While we hear of current important mediation efforts led by the US, Qatar, and Egypt to bring about a ceasefire in hostilities in terms of the Israel-Gaza conflict, which could change the geopolitical dynamics in question, a lot of uncertainty prevails at this stage. To date, leading parties to the conflict, like the US and Iran, have acted with some restraint, and in KBRA's view, this has served to limit further escalation and avoid a scenario where oil and gas traffic through the Straits of Hormuz is disrupted. Further broadening of the conflict risks a much more significant impact on the global economy, and we will continue to monitor the situation with interest.
Very interesting, Ken. However, while the Israel-Hamas conflict is raising the geopolitical tension index, oil and gas prices have remained relatively range-bound with no notable political risk premium impacting prices. Many market participants anticipated that escalation of the Israel-Hamas situation might have been accompanied by more material swings in energy prices, placing pressure on inflation and global growth. However, despite the impact of the conflict broadening to include Houthi attacks on shipping in the Red Sea, the effect on energy prices and global growth has been subdued to date. Kareem, what's your view on why these prices have been kept in check?
Thanks, Gordon. I think this situation, as you say, is rapidly evolving. At the moment, the way we see things is that it's notable that there has been the broadening of the Israel-Hamas conflict to include regular Houthi attacks on shipping through the Red Sea, which has reduced freight container volumes by 65% compared to expected levels, and has forced some large oil and gas shippers to reroute via the Cape of Good Hope, basically avoiding the Bab el-Mandeb and the Red Sea. Further, some companies such as Qatar Energy have halted transportation of liquefied natural gas owing to the Houthi attacks. But that said, in our view, the effects on energy prices have been muted. because of several mitigating factors. The first is that oil and gas shipping volumes through the Red Sea account for just 9 or 10% of global traffic. The Strait of Hormuz, by contrast, is a much more important route for oil and gas shipments from the GCC to Europe and Asia. So far, the strait has not been affected by the recent Houthi attacks on shipping or the counterattacks from the international US-led coalition. Second, there are alternative routes, such as the East-West pipeline. Now, this is a long pipeline, about 746 miles, that runs from the Abqaiq oil field in the Saudi Arabian Eastern Province across the width of the country to the Red Sea. The pipeline allows oil and gas to bypass the Bab el-Mandeb, the strait between Yemen on the Arabian Peninsula and Djibouti in the Horn of Africa. Now, this pipeline has provided an alternative route for oil that is targeted to pass through the Suez Canal, although we should note that it has limited capacity. Third, there are a range of important supply-demand factors that come into play here, including the OPEC tapering. For example, this week, OPEC announced agreement on maintaining low supplies, at least until the next June meeting. Gas storage levels in Europe have been particularly healthy, impacting European demand, and the energy transition is reducing the gas-to-power needs, as well as macroeconomic conditions in China, which have been soft, and the rerouting of Russian supplies, both of which Ken can speak to.
Yeah, thanks, Kareem. Agreed. Ken, would you be able to expand a bit more on the macro factors in China and Russian activity Kareem alluded to, which might also be keeping a lid on pricing at the moment?
Yeah, I mean, for starters, in the Middle East, the major powers have yet to butt heads. And in fact, there is now more discussion of a ceasefire and negotiations to further ease tensions. However, ignoring this, the demand backdrop was already relatively well placed to keep pricing in check. For example, in a recent US Energy Information Administration short-term outlook, which was published in February of this year, there is an expectation that crude oil prices will face downward price pressure emerging in Q2 of this year as global oil inventories generally increase through their forecast period. China, a key market for oil and gas deliveries from the Middle East, continues to display subdued demand for oil and gas. China's overall economic growth is expected to continue to be weighed down by pressures on the property sector and a general slowdown in demand. This soft demand environment in China is acting to broadly limit oil and gas prices, and it will be important to assess and monitor the evolving trajectory of this economy and its turnaround. A degree of Russian activity has migrated away from official channels, according to a number of news reports. So while official activity has remained relatively steady, there has been an increase in the amount of oil being sold to avoid sanctions. Russia has overtaken Saudi Arabia as the largest source of oil and gas to China, and a large number of shipments are also migrating to India away from Europe. Russia's need to keep the taps on, despite the OPEC Plus agreement to cut production, is driven by a costly war. Going forwards, this steady supply from a large supplier should work to keep a cap on oil price increases.
So with that backdrop, it would appear that the recent geopolitical tensions are not immediately having a major impact on the energy sector. But this is not just about oil and gas, is it, Kareem?
No, it isn't, Gordon. As mentioned earlier, the Israeli-Gaza conflict has had an impact on the shipping sector. After the pandemic-related disruptions and a subsequent surge in demand, shipping costs have increased dramatically in 2021 and 2022. Since then, market prices has been on a downward trend, returning close to levels prior to the pandemic. However, the cost of shipping has increased since October 2023 as a result of the Middle East conflict. In particular, the Red Sea disruptions caused by the Houthi rebels have forced an adjustment to product supply chains, with liners containing oil and gas shipments diverting around the Cape of Good Hope. For example, the Baltic Dry Index and the Drewry World Container Index have both highlighted increases in pricing on the back of the Houthi actions in the Red Sea. Now, these indices capture general container line behavior across the globe. These elevated rates may decline from their immediate surge if geopolitical tension were to subside and supply chains were to be given time to adjust, easing pressure on pricing.
Yes, but they won't do so without having had some impact on corporations. How do you see this feeding through into companies and their profitability and bottom line?
I think the backdrop is that we're still seeing elevated energy costs if we compare with pre-pandemic levels, albeit they're not as high as they were in 2022, and the increased shipping rates can, of course, impact corporate profitability and corporate margins as they weigh on the company's cost base. Now, this coincides with a phase in which many companies are still recovering margins from the increased input costs and interest rate increases in the last period. To date, the impact on corporates has varied depending on the sector exposure, the ability to pass through costs, and relative credit quality, with investment-grade corporates having less floating rate exposure being able to weather the higher costs more effectively. Now, cost pressures for corporations should start subsiding as inflation declines and prospects for rates improve, although a lot depends on final decisions by key policymakers such as the European Central Bank. An extreme scenario, such as the closing of the Straits of Hormuz, which accounts for around 30% of seaborne crude oil exports, would, in our view, be a much more consequential event. In particular, those European credits that are exposed to energy input costs and have limited hedging or ability to fully pass through input cost increases in a timely manner. More generally, any such extreme scenario, while impacting oil and gas prices, inflation, and rates, could also begin to impact global consumer sentiment, impacting consumer-sensitive corporate sectors, for example, such as retail. European retailers who rely on inventory being transported from Asia, and some of whom hold limited stock volumes, could begin to experience more obvious effects to the extent current disturbances persist for several more quarters in the Red Sea. For example, working capital, operating margins, and profitability could come under more significant pressure in such a scenario. Further, persistent interruptions to supply rerouting via the Cape of Good Hope will begin to impact these corporate functions. Overall, we think the scenarios, including a broadening out of the conflict to other major players, or more sustained and persistent interruptions due to ongoing Houthi attacks, create a backdrop where credit quality for European corporations could come under focus more meaningfully.
Thanks, Kareem, and thank you very much, Ken. As we have outlined, the risk of price increases has risen as geopolitical tensions remain elevated. While oil and gas prices currently remain range-bound, they are still elevated compared to before the Russia-Ukraine conflict. Although damaging, the effects of higher shipping costs on corporate performance could potentially still be contained to certain sectors, such as retail. Further, more positive sentiment around the trajectory of interest rates and inflation and alternative routes for transportation should provide some mitigants across the European corporate sector. However, given tensions remain high, there may be further price volatility ahead, and the consequences of these will be borne by corporations and consumers through escalating input costs. That's it from us today. As always, we hope these conversations in credit help to illuminate the many trends taking shape across the markets. For more in-depth coverage of the themes discussed today, or to learn more about our unique approach to credit, sign up to the KBRA website to read all our research. Have a topic idea or comment you'd like to share? Reach out to me or one of the KBRA analysts on today's episode. Be sure to subscribe to the podcast so you can be notified when new content is available. Invite your colleagues as well. We'd love to count you all as informed listeners. This is Gordon Kerr thanking you for being part of the conversation. Take care, everyone.